The crash is coming. Michael Burry predicts economic collapse. Michael Burry predicts economic collapse. Michael Burry sees the coming stock market crash as inevitable and has nothing but disdain for the Federal Reserve's efforts to stop it, which he believes are doomed to fail. Will the stock market collapse in 2017? Only time will tell, but according to Michael Burry, it's coming ... and it's going to scare the living daylights out of investors when it does. The overall economy. There are two sources of information, said hedge fund manager Michael Burry, who famously shorted subprime mortgages in 2007. One is sentiment and price action. The other is fundamentals. Currently, sentiments are good and prices are moving higher, but fundamentals continue to worsen. According to Burry, gross domestic product has been growing at a slowing rate for 5 years, with no growth expected for 2015 and 2016. In addition to negative GDP growth next year, it was recently announced that first quarter GDP contracted by 0.7%. Furthermore, unemployment remains high at 6%, according to the Bureau of Labor Statistics, BLS. Meanwhile, both retail sales and housing numbers have declined in recent months. The stock market continues to rise. When one considers these economic indicators, as well as an overvalued stock market that just hit a record high despite low interest rates, deflationary pressures seem more likely than inflationary ones. One doesn't need a degree in economics or be an economist like Burry to realize that something isn't right here. In an interview with CNBC on April 17, 2014 titled "Watching Housing Data Closely," he states, "It's possible we're looking at either stagflation or deflation," he said on CNBC's Futures Now. "We've had quantitative easing for 6 years now. There's no reason why we should expect inflation to go up anytime soon." Yield spread premium, YSP, yield spread premiums, or YSPs, are essentially a way for investors to get paid to invest in riskier bonds. If a bond is trading at 100 and its required rate of return is 8%, then it's worth $8. But if there's an investor out there who will buy that bond at 98, then you can effectively borrow money from that investor for 2 years at an effective interest rate of 10%. The difference between what you pay, 98, and what you receive, 100, is your yield spread premium. In other words, investors will pay you 2 points above market just so they don't have to hold your risky asset on their balance sheet. This might sound like a great deal until you realize that those same investors could have bought an equivalent investment with less risk, say, U.S. Treasury ESA, and still receive 2 points above market on their investment while also having far more liquidity than anything else they could purchase with those funds. In other words, by taking on more risk than they need to, these investors are being compensated with lower returns than what they would have earned had they simply taken on less risk in the first place. Now imagine how much more money these folks would make if we were talking about real estate loans instead of corporate debt securities. Cash for collateral debt positions. The debt crisis in Europe is not just a problem for Europe, it's been slowly brewing for years, and right now, nobody knows how to stop it. The crisis has already toppled one of Europe's top banks and has spread to Germany, which is supposed to be one of their economic powerhouse countries. But even Germany isn't immune from these problems. Because there are debts to be paid and money must come from the somewhere if it hasn't already been spent. Let me explain. When a bank makes a loan, they don't have all that money sitting around waiting for you to borrow it. Instead, they borrow your money from other lenders by selling bonds or taking out loans themselves with other financial institutions, such as the Federal Reserve. This system works well enough when times are good. But when things go bad and those loans can't be repaid, as was seen during 2008, we have serious problems on our hands. As most people know by now, we had a very serious banking crisis during 2008 where hundreds of banks were shut down overnight because they were too big to fail. Meaning that if they went under, so would everyone else in America due to exposure risks. Home prices, like stocks and bonds. Home prices are also poised to fall in 2011. As of November 2010, all three major price indexes, AFNC, Case-Shiller and CoreLogic, were recording year-over-year declines. However, as shown in Figure 1 below, home prices have not yet hit their lows from previous downturns. This suggests that we may have a ways to go before we see a bottom for housing prices. The current average U.S. housing price is $161,000. If it falls another 10% over 73 days, the time frame given by Mr. Burry, it would mean an average price of about $135,000. That's still more than double what homes sold for at their low point during prior recessions. Credit default swaps. In May 2009, Michael Burry was featured in a 60 Minutes profile on his predictions of a market collapse. According to Business Insider, at that time he had made $250 million off of his investment. But what are credit default swaps, CDs? Simply put, they're insurance policies that banks can buy to protect themselves from defaults on debt. So when you hear about CDs, you shouldn't think insurance. For more detail, here's Investopedia explaining CDs in layman's terms. And if you're looking for additional information on Mr. Burry, CNBC has an interview with him as well as a short background piece. So how does all of that fit into our prediction? Well, we've heard a lot recently about rising interest rates and investors trying to decide whether or not it makes sense to jump into bonds now or wait until later. Here's where Burry says everyone is going wrong, because it won't be long before bonds start failing left and right due to lack of buyers. So why will everyone be terrified in 73 days? Because everyone knows bonds are supposed to be safe. So when they fail, people will panic and try to sell everything they can before everything crashes. Excess leverage. My biggest concern is that I believe there is now excess leverage in our financial system. This will become more apparent as rates begin to rise and asset prices fall. The highly indebted company or individual has a problem when interest rates go up because they have a fixed payment schedule, or a variable schedule based on LIBOR, but their income has declined along with their borrowing costs. If they cannot make their payments, then they will default on their debt obligations, which can lead to cascading defaults throughout our financial system. The first sign of trouble may be an uptick in corporate bond defaults, particularly among companies with high debt loads relative to equity value.